Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently a lot of you have asked me to look at UK REITs or real estate investment trusts in the United Kingdom, especially the house builders, and that's what I want to do. So a lot of you have asked me this on the Discord. I just want to make sure that we get the bigger picture first, and then we can talk about specific stocks. So real estate investment trust is a good way if you don't, of course, if you don't have the money to buy your own house. It might be a good way to invest in the housing side of things. And of course, they pay excellent dividends because they are kind of forced by the government to pay a lot of the net income as a dividends. So what I want to do now is I'm going to talk about generally what is happening in the housing market generally, and then look at some of the news coming out of the United Kingdom, and then we will look at some of the companies. But before we do all of that, I would absolutely love if you can basically like this video, subscribe to the channel, let me know if you have any questions, and most importantly, if you can join us on the Discord. Okay, this is how you can support the channel. It takes a lot of time and effort to put these things together. I would absolutely appreciate if you can join us, where you get access to the Sharia compliant investing ebook, you get access to the watch list, you get access to the Discord and other things as well. So if you could do that, that would be absolutely amazing. And liking the videos doesn't even cost a penny. You just press that button and it actually does it automatically for you. Press that notification, so hopefully you know exactly when we release next video, inshallah, so you don't miss anything out. This is my portfolio. As you can see, is actually done all right this week. We're now on basically closer to £83,000. This is all-time high for the portfolio. Let's hope it continues that way. But again, as knowing the market and what it's like, sometimes it goes up, sometimes it goes down. It's normal. Okay, right, let's talk about this. House prices rise for the first time in 6 months, says Halifax. That was about 4 days ago when this news came up. I was like, this is interesting, and this is when I decided to look at the actual basically market and just see what's going on, because it's interesting in the way things are going right now with interest rates being so high, to see a rise in this month. So I thought, let me have a look, and I'm going to show you this is misleading. Okay, right, so first thing we're going to talk about here is the average prices. So the UK's largest mortgage lender said, so this is Halifax, right? Prices were 1.1% last month, taking the average property value to £281,974. But the Halifax said the rise was due to the lack of homes for sale and demand from buyers remaining weak. Now, think about the bigger picture. Okay, the Bank of England have raised the interest rate to now almost 5.25. Okay, so here we go. It's basically 5.25 in the past meeting. So they left it as it was. Now, this is quite expensive. So if the Bank of England is doing this, of course, then that means the actual banks will then charge a couple of more percentage. So when you get a mortgage, you're not going to get 5.25. You're going to get about 6, 7, 8, depending on if you're doing those Sharia compliant ones. You're looking about 10%, double almost. Okay. Now, who on earth, in a situation where the UK right now, the way things are looking, and the fact that we've got recession going on, who can afford 10% mortgage? And I'll explain to you in a second why that the article is a little bit misleading. Okay. And this is it. It says prospective sellers appear to be taking cautious attitude, leading to a low supply of homes for sale. Now, this is the most important part about this whole article. And the reason I said that is because people don't want to sell their houses right now, okay, because they're a little bit worried. So they're taking basically a cautious attitude, which then means, okay, there's not enough houses out there to be bought. Then that creates basically sort of a high demand for houses, which basically really doesn't exist. So this is likely to have strength in the prices in the short term, rather than prices being driven by buyer demand. So there's not that many people out there with a lot of cash ready to buy, enthusiastic about the whole economy and everything else, because the people are not willing to sell their houses right now. Okay, and they're a bit worried about what might happen. They don't want to remortgage, they don't want to buy new, because remember, if you sold your house, you must be remortgaging, you must be buying a new property, you must be buying to whatever. Okay, so for that reason, that's why there's basically it's created this false demand for housing. Okay, and remember, this is only 1 month or basically 2 months or whatever, whenever they've done the research. So don't believe everything you see. The interest rates are very basically high right now. They'll probably, if you go to Halifax or Nationwide, will probably charge you, I don't know, 6-7%, if not higher right now. And for that reason, not many people will buy the houses. Now, why am I talking about this? I'm talking about this because I want to give you the full picture. Because if you're investing in companies like, company Persimmons, for example, that we're going to look at today, you need to know is there a demand for a brand new houses? Okay, yes, UK, there's a shortage. But again, the type of houses these companies build, okay, is there demand for it? Do people actually have access money? Is the interest rate low? Remember, in 2020, 2019, 2020, interest rates were zero. For that reason, there was a basically boom for housing prices. I bought 1-bedroom apartment in Leicester for about 72, give or take, up to everything we've included, okay? Now, guess what? Now next door in the same building now is worth £90,000. I bought it in March of 20. Basically, I started the process in 2021. 2022 March is when we completed, and since then it's gone up about £20,000, which makes absolutely no sense. Absolutely no sense. So I'm hoping, well, according to this, basically this is what they say. Given that outlook, so basically the fact that the interest rate is very high, Halifax said it's expected the house price to fall further overall, with the basically return to growth from 2025. So it's gonna come down quite a bit in basically between now and 2025. So let's see what happens. Okay, so you got the basically the current what's Halifax saying there is basically in terms of the house prices down from the last year. So you can see there's a bit of a drop for Halifax and Nationwide. They collected their data differently, so that's why there's a bit of a difference. And in fact, I can show you that Halifax basically year on year is down about 5%. They take, what they do is how they figure out their calculation is Halifax uses data of house prices purchased transactions has financial to measure market change. Okay, house purchase transactions that happen already. So almost 5% down. This one is about 3% down, and this one they use mortgage approvals. So once the mortgage has approved, they use that data to actually come up with their right move. More or less uses the same increases of the same time from since 2008, and then basically. And for Office of National Statistics, basically they're using the actual date land registry. So that means once you bought the house, then you have to register with the land registry. So they use, this is probably a bit more accurate, I think. But yeah, so they use that data, and all of them basically you can see is down, and I'm sure it's going to continue going downhill. Okay, because I can't imagine people paying 7%, 8%, whatever mortgage rates right now. I don't know exactly what it is right now if you go to the banks and stuff like that, because I'm not interested. But I'm sure it would be very, very expensive. So what I want to do is now to look at a couple of companies that you guys have said you want to buy, and knowing what the market is going to do, is it good time to buy this type of companies? Of course, it's entirely up to you. Now I'm just going to look at the financials of these companies. The first one is Persimmon. Okay, again, I could be wrong. Things could completely change. So first thing we're going to do is look at the evaluations. Okay, and this one, according to Simply Wall Street, is actually down. Basically they're saying is undervalued about 60%. They expect the price to be almost to £30 right now, and the reason they're saying is that because they expect, okay, the earnings to grow about 11%, okay, revenue growth rate of 1.2, and return, basically future return on equity of 11%. So analysts basically think it's actually good investment right now, and that was updated on the 10th of November. So looking at the future past investments, okay, this company has absolutely, that's probably why it's now coming back to, positive territory, because right now, before you basically returned minus 10%, and maybe it hasn't recovered from COVID times. And as you can see here, this is their revenue. Okay, as you can see, the house building, the revenue basically 3.32, the UK house building, and then revenue was 3.32, of course, and then gross profit of less than a 1 billion. Cost of the sales basically was $2.72 billion. That's very but then again, we're talking about house builders. They use a lot of material, and there's a lot of that money goes back to the construction. This is why I try to stay away from house builders, because their cost of sales, like basically, the cost of making these houses is very, very expensive. And that's why I try to stay away from any companies that actually have so much capex. It's not worth it is worth investing, of course, but if they're going to spend a lot of their money, their revenue, back to paying off for everything else, the land and basically the constructions and all of this architect and all of that stuff, then you're not going to make a lot of profit. So for that reason, I'd rather invest in REITs that have those storage ones, like the public storage, for example, is a good one. They buy these places and then they rent out, and then the rental income is basically what they use. So they're not going to spend a lot of money building new houses every single year. The other thing I've realized is about this one is their cash flow here is actually declining. So right now it has 134 million free cash flow in terms of pounds. But at some point they had 1.24 billion. Again, that's probably a lot to do with the fact that they have to use some of that money to, of course, acquire new land and all the other stuff that they need to pay. The good thing is it has a liability of 1.36 and total assets. So total liabilities is only 1.3 and total assets is $4.7 billion. So that's pounds. So which is basically quite good in terms of that. And the cash, like I've already said, it's got 357 million right now. In terms of assets, of course, it's a property side of things, so they've got more assets than liabilities right now, which is quite good. In terms of what else do I need to see? I need to see their dividends from side. Okay, so right now 3.5 yield and 77% payout ratio. Again, these companies do have a basically huge payout ratio. What I would like to see, wow, look at this. Right, so it's not stable at all. I think they've cut their dividends not long ago, because it used to be about 9% or whatever it was. So it doesn't look great in terms of dividends. Again, one of the things that I love about dividend investing is that I like to have companies that increase that dividend and reliable dividends, because otherwise what is the point? Because you're not going to get a lot of price appreciation from these companies. Maybe if you hold it for 10 years, especially if we look at the total return in the last 10 years. Let's have a look actually. So just to look at in the last 10 years, only last 5 years, okay, you can see it's down 46%. So 5 years is down 46. And a lot of it is probably, since COVID actually, is down 65%. So from the way it was on the height, okay, and then the lowest it's been to right now where it is almost 30% down from the lowest it's been when basically when COVID happened. It went down quite a bit. From that point up until now, it's down 30%. This does not scream. Okay, if you look at the S&P 500 and so on, they up so much, and this one is down 30%, 46% in the last 5 years. So you're not going to get price appreciation. So the dividends has to be solid. It has to be increasing and so on if that's what you want to do. Let's have a look at their dividends. And there we go. So I'm looking at Dividend Max website. So as you can see here, it was high and then they cut it. This is not reliable at all. Okay. This is, if you own 100 shares, you'll probably get about 20, apparently, according to this website. But right now, it doesn't look great. Okay. From where it was and to where it is right now, it does not look great to me. So if you're investing in this type of company, right, and you think that basically it's down quite a lot, maybe if they write about it and it actually bounces back to $20, whatever, £20, you can double your money, and I hope that's the case, and that will be absolutely amazing. But right now, the future expectations actually look good in terms of the valuation. If this company used the right metrics, okay, it looks good to me. So yeah, it's not bad, but looking backwards, it does not look great. So I'm hopeful that they will bounce back, and hopefully even if they get to 20, that's almost basically doubling your money. So you're going to triple your money if they do exactly what this company is saying, simply Wall Street. So let's have a look at the next one. And the next one you asked me, guys, is Taylor Wimpey. And this is, again, similar sort of a situation. They have one of the house builders in the UK. I don't know which one is actually bigger. So this one is about $4 billion. And the other one, let's have a look at £4 billion, sorry. And this one is about £3 billion. So not much of a difference, to be honest. So let's have a look at the future. This one, I believe, is overvalued because I remember looking at, sorry, let's look at the valuations. Valuation, let's go to that final. Okay, overvalued by about 3%, so not much. Future minus 3%, so there's not much growth in terms. Let's have a look at the past. Right, minus 5%, and it's still not recovered. Okay, they making about $3.85 billion pounds, sorry, and gross profit of closer to $1 billion, so not bad at all. So they just spend about £3 billion on the cost of sales. Expenses, by the time they get to literally net income, is not much left. In terms of financial health, let's have a look at that. So cash right now, £740 million. They have 1.8 in terms of total liabilities, of course, because they own so many properties. That should be okay. Total liabilities about £6 billion right now, so they do have a lot more assets, of course, because they're a property development company. Dividend, let's have a look at that. 6% ratio, 8% dividend yield. That's probably a lot of you why you've been asking about this company, because the dividend is absolutely mad. Right, so what we're going to do again is look at that. Right, if we go back, okay, if we look at here, it actually looks like it has increased. So payment has received over the last 10 years, so dividend payment has increased, okay, which is not bad, but it's volatile, so they probably cut a few times. Of course, as you can see there, at one point, look at that, the annual dividend yield was about 10 something percent. Has come down, and their payout, of course, has come down quite a bit. Yeah, this actually looks better, but 2020, I think they had to wait 2019, and then they've increased it in 2021. Yeah, because that's when the housing prices were booming. So maybe they recovered. Okay, so that's not actually bad. So this one is slightly looks better, but then growth side of it is not there at all. So again, I wouldn't know why you would invest in this. It seems a bit overvalued right now. The dividend, basically, it's okay. They cutting that dividend. It's not as reliable as I would have liked. Okay, but yeah, so that's the second one. Let's have a look at the third. And this one is Barrett Developments, and I think this might be non-Sharia compliant right now because of the interest-bearing debt. You just have to double check that. I haven't checked that in Zoya for a while, but look in the valuations. So we'll do exactly the same thing, but you have to, wow, 75%. Do your research, please, in terms of Sharia compliance side of things, but this seems very, very overvalued. Future, okay, minus 2% in terms of EPS growth side of things. Past performance, again, 6%, so it hasn't actually recovered from whatever's happened before. They should have more total assets than liabilities, of course. And in terms of dividend, 63%, 7% dividend, okay. And now looking at, look at that. I think they've stopped paying dividends, by the way. I think they have. Yeah, I think they have stopped paying dividends. I'm going to have to check that in a second. Because... am I wrong? I could be wrong. Because I remember when COVID happened, I think they were one of the companies that stopped paying dividends. But as you can see here, okay, so 2022, so maybe 2023 they haven't paid anything. Maybe they stopped it. I'm not sure, but either way, this does not look great either. So guys, what I want to say to you guys is it's great to invest in the UK companies, and of course, your house builder is probably a good one if the housing market is booming and whatever the companies are doing. Or maybe it's a good time to buy now, and then hopefully in the next 3-4 years it will recover. I don't know what we're betting on, but somehow you guys have been talking about this for quite some time. In my opinion, I don't think these are great investments, all three of them right now. Maybe I'm wrong. Maybe in terms of out of the three, okay, Persimmons actually looks good in terms of the future side of things, but in terms of the dividend side of things, the fact that they've been cutting that dividends, the price appreciation has not been there. In fact, I'm going to check 2 more things. Right, again, doing the same thing for the last 5 years is down about 21%. So again, this is, of course, this does not tell us what's going to happen in the future. It could go up again, but this is not looking good at all. And this one is exactly in similar sort of situation. You can see again about 12. This one is probably done better, okay? But since the lows it's actually up 14-15%. Since the lows is fine. So again, you just need to double check. I think they do pay dividends because it says there as well. But yeah, so that are the 3 companies that basically you guys have asked me to look at. But I'll be honest with you, you really need to be careful with these companies. There are other REITs out there, not the house builders, that probably be better investments, okay? REITs are like the storage kind of REITs, because I do own one REIT, and that's Public Storage, and this company basically builds those storage places and people rent from them. And of course, when you know it's one of those companies where if the market, when people are buying new properties or when people are actually moving out, they actually put all their stuff into these storage places and leave them there for months, if sometimes years, and that's how they make their money. And there's loads of them around the world. If, like where I live, there's like 5 minutes away from there's a massive storage place, and it always seems busy. So I'd rather invest in these companies rather than the housing developers. But yeah, I didn't want to make the video slightly longer, but I think there was a lot to cover, of course, and I hope that kind of helps you guys. It's very important to be careful with these sort of investments, because what you're looking for is basically the long term, and basically in terms of your returns, you're thinking about 5 to 10 years from now on. And if you think it's a good investment in the next 5 to 10 years, just ignore me, just go for it. But be careful with the housing prices, because just like Rio Tinto, if the iron ore prices are down, okay, everything is doom and gloom. Same goes for these companies. So if you own 1 or 2, maybe okay, but don't overload your entire portfolio into this kind of very cyclical businesses, if you like. Anyway, I'm going to stop here. I hope you enjoyed that. Have a wonderful day. Assalamu Alaikum.